Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Michael Oliver, founder of Momentum's Structural Analysis, is a leading expert in financial market trends. Known for his momentum-based analysis, he identifies key market shifts across commodities and equities. With decades of experience, we'll be picking his brain and asking the questions that you submitted. Michael, thank you for coming back on the show.
Great to be back, Steve.
Pleasure's all on this side of the table, sir. Let's start out like we always do and go ahead and give us your macro view of the world economy and financial markets today.
Oh, gosh. Okay. This is going to be a very dynamic year. I thought it might begin originally late last year, but it didn't. It was held off, and we got constipated end of the year action in the stock market, for example, narrow up-down range. No dynamics, just, oh boy, this or that. Trump got elected, so they bought stocks, they dumped gold. The guys who dumped gold were dead wrong and immediately got into a losing position, and now it's making new highs. And the guys who bought stocks, they're making a few percent, actually, since the election. Not much, but it's not the current things that are happening that everybody seems to be focused on about, well, what about the tariffs? What about China's response? So all these various and sundry things. It's events that have built up over years, decades even, that create dynamics. Like what caused the dot-com pop and collapse from 2000 to 2002? Was it something happened? No, it's the overpricing of something that occurred before. Namely, by 2000 top, we'd overpriced the reality of the internet. Now we've got, a similar thing with AI and so forth. So it's not what's about to happen that matters. It's what has happened and it will unravel. In particular, we think a major dynamic is the stock market. And why is it a major dynamic? It is the biggest stock market bubble in U.S. history. Now, you can say, well, we had a good, strong economy for 15 years. Well, yeah, or you can look at the M2 chart and see the growth in the money supply is more over the last 15 years than prior periods, but especially look at a Fed funds rate chart, get it on the St. Louis Fed site. Go back 50 years and look at rates that are controlled by the Fed, the short end of the market. And you'll see that they dropped it to zero. Okay. So the last 15 years, you've had zero Fed funds rate, and then it was interrupted by the rate rise we saw a year or so ago. But even the peak of that rate rise was very shallow historically compared to what we've seen in the last 50 years. So we've had super abnormal, artificially low cost of money. Well, money is the most essential commodity in human transaction. No matter what you're buying, selling, services, or goods, it's ultimately the money that exchanges hands that is the essential commodity. And you make a decision in buying or selling or investing in a new factory or building a new home for you and your wife, et cetera. The cost of money is a major factor. So if the cost of money is artificially fake low, then you might just be making a mistake in your investment plans. That, one of the fundamentals in your plan is based on the price of money. And, it didn't stay there, or whatever. And you built unusual debts based on cheap money. And suddenly somebody rips the needle out of the arm and you're no longer receiving the hallucinogens you were receiving before. And reality starts to hit, debts get exposed, and it's based on events of the past, built up over years, not just Biden administration, but, before that. And these things unravel. Well, this is the biggest bubble in history. We've had about a nine-fold bull market in the S&P from the 2009 low to present. And I think it's like an 18-fold move in the somewhere in the teens on the NASDAQ 100 in terms of increase in price over 15 years. So it beat handily at the S&P. It beat it. It was the leader, just like back at 2000, internet stocks were the leader. When that bubble breaks, many assumptions that are based on the cost of money will be exposed, not just the stock market bets, but debt's accumulated, like in the commercial real estate arena, which is an area we're definitely watching within the stock market, because it's heavy with debt. It's not performing well, and I suspect there's going to be some news out of that arena, separate and apart from AI situation. But anyway, once that gets busted, that's going to cause dynamics in other markets. And even in the 2000 top to the 2000 low, where S&P went down 50%, NASDAQ went down to 82%. Okay. It was the leader upside, leader downside. And it took it 16 years for the NASDAQ 100 to ever get back to its 2000 peak. So it was not just damaging during the bear, but from an investment perspective, even nominally getting back to the old high. Took a decade and a half plus. Wow, what a waste of an investment time. And then 2007 to 2009, it was only 2 years, but it took it quite a few years to get back up to the 2009 low for the S&P. It was like 2013 or so, I think, where we got there. But these exposed errors that had already occurred, but also caused money to flow into two different markets, alternatives, T-bonds and gold. Did well during those bear market years. In fact, gold did well up to 2011. Okay. We expect that to show itself again this time, only even more so, because the bubble is bigger. The errors out there in the economy are bigger. When they get exposed, when that money flees that bubble, it goes somewhere. And it's already going into gold. It's apparent. In fact, shock to most, go back to the close of January 2024 to the close of last month, 12 full months. Gold was up a lot more than the stock market. Silver was up more than the stock market. But that's not a headline. Nobody's noticing that. Then just last month, the winner was the gold miners up more than anything. Silver up next, gold up next, and the tiny little upticks in S&P and NASDAQ. So even when you go back a full year, and if you want to go back 10 years, you can find similar type results. Very interesting, which most people aren't aware of. Why not? They're all caught up in the bubble fever. But when that goes away, emotion comes into play. We don't have emotion right now. In other words, you've got a happy fever. In fact, for the average guy on the street who looks at his life, like let's say different TV screens in front of him, my debt problem is not good. Oh God, I owe the IRS some money. Oh golly, I hope they don't lay me off if the economy turns down. One good thing, my retirement account, it's up X% last year. Oh boy, I'm smiling. Take that away from him, got nothing to smile about. And we're betting based on technicals that they're about to take that away from them.
Okay, so I'm going to share my screen real quick here. Basically, to summarize, you're saying that you expect a dynamic year. There's been a buildup of just years of an overpriced stock market. And if I bring up the Fed funds rate here, and so this goes back to the 50s, pretty simple line chart. But this is what you're talking about here, right? Like 2008 to just free money. And when money doesn't cost anything, people tend to put it in stupid stuff. And this is what's happened for this huge amount of time. We had a little bit of a recovery there, then just free money again after COVID. And this is just years of bad investment. And this is the area that you're talking about, right, Michael?
Yeah, that's correct. And, when you get the injection in your arm that makes you hallucinate, that the price of money is free and it's going to stay that way because it's so long, even that blip we just saw, if you look historically, it's not a big deal. It's not real high, and it's coming back down. And believe me, it's going to come down more when the Fed gets punched in the face with the dropping stock market. Why? Data points follow the stock market. It's not the other way around. You go back and look at 2000 top, 2007 top. By the time the data points turned real negative, dark, you were off the highs, pretty far off the highs in the stock market. The stock market went first, then came the data points. And so the Fed can say all they want about, we've got this two mandates here, and we're not got inflation down to where we wanted, but we got a strong economy. Good job, market. Well, that'll go sour in about 2 months once you break the stock market. And what are they going to do? Pedal to the floor. And it's not just the Fed, it'll be the BOJ, it'll be the ECB. They'll all be printing together. It's the club and printing, buying assets, cutting rates, you name it, whatever they can do, which will also degrade the underlying value of their fiat currencies, which means gold goes up. The
Yeah.
real, you know, it's that simple. And it's not based on what's going to happen next week. It's based on what's already happened and gets unleashed. Period.
Yeah, I remember watching an interview by Jason Hartman. He's a real estate guru,
Mhm.
and he was talking about that period of low interest rates like that. And he said
Yeah.
something that I've never forgotten. Is he said that was the lowest that interest rates have been in 5,000 years. That's the cheapest money's ever been. And I'm
Yeah.
like, wow, we lived through it. I should have borrowed way more than I
Yeah.
did.
Yeah. Yeah. But the problem is if you don't get out right, that whole thing comes collapsing back down on you like
Oh,
a
that's
ton.
true. Yeah,
And
fixed
in
rate debt
fact,
at 30
yeah.
years is.
And most of the investors didn't get in low. They got in high, like in the last year or so. And oh, jeez, you feel sorry for them, but that's the way it is. You have to be on the right side of reality. That's all.
It makes a market. It makes a market. Okay, I got some listener questions here. One on gold, and this is from Tile Brick, and he said, "What is the relationship between U.S. interest rates and the price of gold?" So he's basically asking, probably talking more about the 10-year Treasury yield.
Yeah,
What
yeah,
is the price of the dominant fiat money
yeah,
versus
yeah.
the price of real money over the next?
Well, the interest rate correlation is not really good. In fact, if you go back and look at the period of a stock market wasteland, which is the mid to late 70s to 1982, there was a period in there where we had what they called stagflation. People didn't believe it could happen. Economists were dumbfounded by it. How can you have rising commodity prices in the late 70s, and yet you have global deflation or global stagnation or recession? Global. Yeah, and back then, the Fed was raising rates like crazy, short-term rates, off the page. What was going up at the same time? Gold and commodities. They didn't care about the Fed raising their short-term rates. Okay. Now, and there's times when the direction of T-bonds, the longer term, can be in sync with gold or out of sync with gold. It's quite often in sync with gold, meaning rising bond prices as people buy that asset and get out of the stock market, like 2000 to 2002, 2007 to 2009. They were buying T-bonds and they were buying gold. Why? To get the hell out of the stock market. It wasn't so much of a sober decision. It was, I got to find a place that's safe and going up, and those were going up. And gold continued up. However, in 2020, bonds made a top in price. T-bond futures were up to the 170, 180 level, okay, in price. They got down near 100 recently. In October of that year, we put out a report based on annual momentum and quarterly momentum of T-bond futures and said, that's it, top in place, we're going down. In other words, we're going to collapse the price of T-bonds. And the yields rise on the long end. This has nothing to do with the Fed. They don't control this end of the market. This is long-term U.S. government debt. And it collapsed and yields went up into 2022. And then since 2022, the yields have not gone down again. They've laid there. It stayed high at high rates. The price has stayed low at low levels for like 3+ years now. So ongoing, that's a choking effect on people who have long-term debt, hoping to heck that the rates would come down, but no, you got to pay these debts off now. They're coming due, and the rates are still high. So that's why, like, we're watching commercial real estate, for example. But bonds, there was a period in the last few years where there were a few waves up in bonds price, drop in yields, coincident with gold. But that changed recently. I think it's about to get back in sync. T-bonds are trying to put in a bottom in price and turn up. In fact, they traded the other day within several 30 seconds of a level it takes to break our quarterly momentum out to the upside. The problem with T-bonds is even if they are an alternative to the stock market gets a hole punched in it, money flows into bonds, it's likely to only be viable for a quarter or so of a year, not a year. It's not a bull trend because the annual momentum trend of T-bonds is broken. The beast's backbone is broken. Any rally you get now is what should be called a counter trend rally. So don't be deceived if the stock market starts down and asset managers start to buy T-bonds. Yeah, it'll work for a while, but it isn't really going to be lasting. The alternative that will last is gold and related.
Okay. When you're talking that, you mean like short term T bills, or you mean like the
No, I'm
TLT? Or
talking the long end. Yeah, 10 years on out, especially
okay,
30 years is what we're watching. So those are the ends of the market that the Fed, the government really doesn't control very well at all. Yeah, they control the 90-day stuff. Okay, fine. But that's not what really is going to break people's back, companies' backs, governments' backs. It's the long-term debt end of the market. And while you might get some relief on the long end if and when the stock market breaks, which we think is in process right now, uh, it won't be a lasting alternative. The one that will be the alternative that will persist will be the monetary metals, as they've always been. Um, anyway, that's what I think we're looking at right now, is a coincident up move in T-bonds and gold, with gold being the lasting one, but T-bonds following, as a panic sets in. And those are the only two alternatives I see, other than the broad commodity complex. We can get into that later if you want. I think it's likely to turn up too.
okay. Well, that's good news if you're in the commodity index. Okay, so you could see possibly a trading opportunity here
T-bonds.
with T bonds, but not something that you want to
Yeah,
buy and hold.
don't stick around don't expect to stay there for a year, maybe a quarter or so. And
Okay.
it should be a sharp move because I think it'll largely be fueled by panic money moving out of a deflating asset category into one that is perceived to be cheap and safe. Why it would be perceived to be safe at this time, I don't know, but counter trend rallies do occur. And I think that's what we're about to face in T-bonds.
Okay, so this what you're talking here, like this is the TLT. I'm just pulling this as kind of a proxy here. You could
Yeah,
see
yeah.
a quick little revamp here, going from 88 to maybe
Mhm.
95, 100. But
Yeah, no,
yeah,
I think those recent highs that we saw over the last couple of years
yeah.
in T-bonds and in TLT, which is a 20-year plus maturity, you might take them out.
Okay,
Now, I wouldn't get all in love if you take them out. Yeah, the price will look fine. You take out those highs. It's a quote bottom. But right now, I would just be focused on the potential to rally from where we are now up to and possibly through those highs.
okay,
That would be largely due, again, not to the virtues of T-bonds, but to the perceived lack of reward, higher risk in the stock market. It's simply place to go. I'm
yeah,
scared.
okay. But you expect that one to be pretty short-lived, and
Yeah, like a quarter or two at most. It's not a long-term trend. No.
yeah, traders only. Okay. Um, Aaron wants to know. He says, "Do you think the ongoing tariff war could accelerate money flow towards precious metals?"
No opinion on that. I think it is a quote disruptive factor, meaning something different. It's not the norm that we've seen. And quite often when you get into collapsing situations, even past bear markets in the stock market, you suddenly see things off to the side that aren't necessarily directly connected to the stock market suddenly go awry. Ooh, that idea didn't work. Ooh, that institution's gone. And I think a lot of things are changing in the world. Politics is changing. The notion of unification of statism, the unification of Europe and let's go global and globalize everything, that's suddenly going the other way. So that idea is getting kicked out the window. And it's going to be coincident, especially with the breakage in certain bubble markets. We see events that are occurring that most people can't explain, like in Argentina. Javier Milei got elected president a year ago. He didn't even have a party. He ran against two dominant political parties that have prevailed in Argentina for decades and brought Argentina to a socialist, stagnant state. 70 years ago, Argentina was the seventh biggest economy in the world. Okay. And, became a backwater country. Uh, Javier Milei said, let's get rid of this stuff. It's not working. Neither side. It was socialism. It wasn't working. I'm going to dismantle the state. He's a declared anarcho-capitalist, which is what I am. In fact, I came up with the idea 50 years ago. Uh, but Javier Milei came in, voted in by youth vote too, and a lot of the lower class vote. One of the things that was hurting them in particular was the cost of rents, housing. It was very expensive. And the government had a regulatory body, a rent control agency, that controlled the rental market, made it safe for the people. Okay, well, it was making it stagnant and high priced. And he dismantled it. I mean, he's gone, went private. So it is now a private real estate market, and the cost of housing has collapsed. So, but this guy came out of where? Didn't even have a party. He looks like a rock and roll star. He's an academician, actually, but he kicked butt. Now, why did this happen? It's not isolated to Argentina, I'm saying. I'm saying that this type of event, these things that pop up that we can't quite explain, this is like the tariffs. All of a sudden, something new. It wouldn't shock me once you break the stock market, let's say 20% off its high. You don't even have to crash it. And you disappoint the average investor. It's the only thing he's got to smile about right now is his retirement account. You take that away, panic sets in. That they abolish the income tax. There's already sentiment to do that among many Republicans. And if you give them the least excuse, you're going to abolish it. That'll be gone. Okay. Now, why? A couple reasons. One, it'll make the public happy. Of course, there's other alternatives. The government will get revenue, but coming out of the public's pocket too. Sales tax, for example, the tariffs, and so forth and so on. But that'll make people happy. But there's an institution gone out the window. Well, it didn't work. Frankly, over the last several years, the IRS has not met its quotas in terms of being a source of revenue for government. I drive down the road in my Toyota 4Runner and I listen to Sirius Radio and I listen to Fox channel or the CNN channel. And 50% of the ads that I hear are, we can help you fight the IRS. Okay. I thought everybody was in good shape. What are all these ads for? People having trouble with the IRS. And another bunch of ads are, we can help you consolidate your debt crisis. I thought everybody was in good shape. The Fed says everything's great. So how come all these ads for IRS problems and consolidating your panic debt situation? Something's amiss there. But anyway, that could be something that simply goes by the way. And so a lot of things that we think are normal, another thing go by the way, I think, and I've said this before, don't be shocked if there's no Fed in a handful of years.
Oh, that would be amazing.
Yeah, well, it's been around 100 years, and it's sort of a foggy type institution anyway, in terms of where did it come from, what's its legitimacy, who gave them godlike powers over the pricing of an essential commodity, money. It's like having the Soviet Union where they control the price of bread or meat. They control the supply and the price. Oh, good. We don't like that. But it's okay when you do it with the essential commodity of human interaction, money. You have a central body of academicians, would be anyway, controlling the quantity of the money and the pricing of the money. The market doesn't do that. Well, naturally, if these academicians make mistakes, they create boom-bust cycles. My, haven't we had that for 100 years? Okay, now you get a boom-bust cycle like we've never seen. And if it breaks, I'm going to tell you, there'll be a lot of people saying, hey, this hasn't worked. Don't be surprised if it's gone. So anyway, like the tariffs, again, are another one of these outside the norm situations that will pop up.
Okay. Sounds like just increased volatility from things like this.
Increased, where's reality? Okay.
Okay, moving on to silver, SSGP wants to know, says historically, silver peaked in a very narrow time frame and then gave back all the gains.
Yeah. Mm-hmm.
Will the growth of the industrial demand stabilize the price or accentuate the motivation to control it even more?
The industrial demand is increasing and the supply is not. We know the supply is basically flat for a handful of years. And it's, silver largely comes from base metal mining. So it's not the prime focus of the miner to get the silver out of the ground. It's to get copper or other base metals, and they get silver in the process. So even though the demand for silver is increasing year by year, especially Chinese demand for photovoltaic cells, solar panels, they're 80, 90% of that market, and that market's growing like crazy around the world. Families having, in Africa, Asia, they don't have a local power company, but they needed some power, and they buy a solar panel situation. Silver is essential in that. So China is a major buyer. It used to be photographs. We take pictures of silver, and there was not anymore. But now it's totally replaced by such things as this. So the demand is increasing. I think that this time around, we have a different situation than we did at the two prior peaks. And similar with the gold peaks. Yeah, when you make your high, basically a couple of years later, you're 50% off the high or something. Silver's case, 80% off the high. It made two peaks very briefly over the last 50 years at $50, thereabouts. I don't think that's a meaningful level to watch. I think the public will watch it. And if you ever take it out, everybody and their brother will want to be buying silver. Fine, let them do it. They're late. But this time we have a crisis situation in so many other markets that will drive them as monetary metals, forgetting the industrial aspect of silver, which could be a unique fuel for silver, unique to gold, give it more dynamic, admittedly. But this time we have a monetary metal situation and a government debt crisis that the outcome of which is not going to be so easy where, it's all solved, gold collapses again. I think the move will be more dynamic than in the past in terms of percent gain by gold and related markets. And by the way, those were eightfold moves. 1976 to 1980, 2000 to 2011. So we've had two eightfold moves in gold, some of which took more than a decade. And yeah, they dropped afterwards. This time, if you had an eightfold move, you go to $8,000 gold, because our low was 1,050. Okay, that's just to getting to a normal ratio move of the prior two moves in the last 50 years. Will we collapse then? I suspect at that point in time, if you get up to those kind of levels, you'll be in such a debt crisis globally that so many things will be in doubt that were normally not in doubt from an investor point of view and citizen point of view, that gold will be up there and stay up there, probably locked into place and is a major backing of currencies. So this time around, I think it's more of a tabula rasa event where we're going to wipe so many things off the page, and gold's going to ascend, and silver and so forth, in such a way that to be thinking and worried about, it's going to peak and trade back down like it's always an inhale, exhale, they could be wrong this time. Something different is going to happen. So I'm hesitant to say, when you make your quote peak, will it really be a peak or just a new reality?
Okay. I'm going to share my screen here, and maybe we can. We're kind of this is like the last eightfold move you're talking about right here, down from '01 all the way up to this almost 2000.
That was one,
just an amazing run,
On a ratio scale, right now we've only gone up 2.5 fold.
Yeah, we still got a little ways to go here.
The logarithmic scale. Yeah.
And so today we're talking February 4th. We're making new all-time highs, like as we're speaking. Normally I would be looking at the RSI and go, "Wow, it's in the 70s." But how much weight do you really put into that right here?
No, we've been warning investors. We went into a congestion zone in gold starting from mid 2020 to early 2024. Mm-hmm. Now, silver and the miners had a corrective decline in layers, zigzag. Gold really had a sideways move with one punch out, but 90% of its action for that 3.5 years, 3.5 years, was in a 15% range.
Yeah, it was just little Charlie Brown shirt pattern.
Look at all the highs above 2000 there.
Yeah.
Okay. Now, each of those was a teaser. It went up there and didn't work. And we warned people, listen, this is not a top. Gold has never topped with multiple horizontal highs. Yeah. All of its tops are isolated. You don't go back and see them again. He might congest, but well off the high. You do not go back to the high again and again and again. It's saying, I'm going through. It went through. But in March of 2024, a year ago, uh, gold was going up to 2000 again. This time it was different because our momentum metrics showed a massive breakout in gold, silver, which wasn't back to its highs then, by the way. It was $25, 25 to 26 zone. And the gold miners, which were GDX then, was just above 31. Right now it's about 40. Okay. At that point, we signaled a renewal of the bull trend after that several year pause. The pause didn't make things negative. It just was a pause.
Yeah.
We said, okay, game on again. And gold took off. Silver at that point was 25 to 26 bucks, and we got up to 35. GDX was 31. It's since been to 44. Right now it's about 40. So we've had a huge move in less than a year. Okay. The issue is, when will we go into a more accelerated phase? And I think we're probably on the cusp of that right now, where you don't go up in that manner that you can see there, where you go up and you consolidate. You go up and you correct. You go up and that type of pause that confuses everybody. I think we're about to enter the phase where you go more vertical.
Okay.
So the good part of these congestions and pullbacks is more evident, for example, in the gold miners. It shakes people out of the market. It spooks them.
Yeah.
And therefore, there's more money to come back in the market when they realize, oh gosh, I did a stupid thing. I got out, and the public that hasn't been interested in the market suddenly gets awakened, and they say, I got to move some money out of the stock market into gold or miners or silver. And I think we're on the cusp of that right now.
Okay. And so that was the gold chart. Silver, now we haven't seen $33 in a couple of months.
Yeah.
We just broke through it. Go ahead and pontificate on silver for a minute.
Yeah. The high we made at 35 was isolated. We had a worse correction in silver than we did in gold, more painful to most people. But you can see that all this action up here since last April, when it got up to 33 or so, and then got to 35. It's all above most of the highs of the prior several years. Now, there was one peak back there at 30, but most of those monthly closes back then were 29, 28 bucks or so. Yeah. So we're still consolidating above that. So it's really not even on a price chart. It's not breaking anything. It's just sitting there inhaling and exhaling with a still upward bias. Long-term momentum that we run, we had a correction, and most short-term metrics said, okay, you're going to correct. Okay. And silver, being the little dog on the leash, instead of running in front of gold, ran behind gold during the correction. And then it's about, I think, to go way out in front of gold. Now, it happens that some of our long-term metrics say if you get back above that 35 again, not because of the price level, but because of certain momentum dynamics that we can measure, you get back up to about 36. And again, it's not because price is taken out that high. We'll engage certain long-term metrics that say you're going to enter the acceleration phase now. Meaning, see those two highs at 50 bucks? Remember those? Gone. Yeah. Gone. They're not going to be there. They are jokes. They're really not technically important except to the average Joe who looks at a chart going back and says, oh, there's two peaks at 50. I don't think those will be even minor obstacles.
Okay.
Yeah,
what do you see as, I've just kind of arbitrarily drawn in like best buy targets here. The closer you get to green, the better buy it is. What do you feel about these levels? I drew 32. I feel like that's got quite a bit of weekly resistance, but we broke through that, which was cool. It's 30 bucks, 28.
Yeah. No, I think you've had your dips. I wouldn't be shocked now if you take that recent action above 33 and take out that last secondary high. That you'll rush for the 35. Gold's already in a new high. Okay. Yeah. So not. Okay. I think, again, the major factor here, there's a couple things we're watching. It's the relationship, not the price charts, not even the momentum of the price of silver, gold, and miners. It's the spread relationship between silver and gold and between the miners and gold. And we've done a lot of studying of this spread, what we call spreads. It's a relative performance. What we do is we divide, for example, the price of silver per ounce into the price of gold. And right now that is 1.15%. Okay. Now, and you go to GDX and you can plot it versus gold and you come up with a percent. Price of GDX expressed as a percent. If you'll go to I've got a chart of XAU index
XAU
versus gold. We'll
I'm
start with
on
the
it.
miners because I think they're the best
There we
place
go.
to be this year. This goes back into the 1980s. Now you'll notice that XAU index, which is the Philadelphia Gold and Silver Miners Index, it's got quite a few silver miners in its top 15 holdings, by the way. I think it's got 6 or 7. So it's not just gold miners. And plus its history goes back a lot further than GDX. So we use it. But you can see from the 1980s to 2008, it lived in a range from 35% on the upside to 17.5 on the downside. That's the big red horizontal there. Those were lows. And it lived between that range of readings, meaning its price would fluctuate between that 17.5 and 30+% of the price of gold. And then suddenly after it peaked in 2000, its spread peaked in 2008, before the gold market actually peaked, the spread broke down. And by 2015, you made a low. Well, that low in the spread happened to coincide to the month to the actual low in price of XAU, low in gold, December 2015, and the low in silver. So the monetary metals bottomed that month, and so did the spread. Now, you can see there's a range we've defined there in that little rectangle that it's lived in for the last 9 years. Up, down, but still at low levels.
Yeah.
And we've edged out above a 3-point downtrend line already. The key is to continue this upside that we've gotten and get out through the top of that box. When you do, there's no resistance until you get up to about 17.5%. Well, right now that spreads in the 5-6% zone, XAU versus gold. To go to 17.5, you could triple its relative performance, meaning you get upside in price in gold, miners, and silver over the next year or two. This spread breaking out could triple its gains versus gold's gains. So if gold went up, to $8,000, which is to say have another 8-fold move, it's had 2 before in the last 50 years, this beast could go to, we'd triple the price of the miners during that same period of time relative to gold and in net price. So this we're watching as an investment opportunity in terms of not just that the trend is going up for gold and silver and the miners, which it is. This does not show that. This shows relative performance. But you break out this relative performance, and I bet, because historically it's been the case, that you will accelerate the price advance in the monetary metals, but you'll blow off the miners in a big way. I think they're the place to be. And the old maxim, buy low, okay? Well, you're looking at buy low here. And in fact, if you take that current measurement and go back to the 2015 low, it says that if you bought the gold miners, represented by XAU, instead of buying gold, you're making more money in the miners since that bear low than you are in gold. Even though the miners aren't through the highs they made in 2020 in price, and gold is, they're still beating gold over that 9-year period.
Okay.
Yeah. Anyway, and a similar situation we have with silver, a spread relationship there.
You want me to bring that one up?
Yeah, bring that one up. The silver versus.
Okay.
Yeah. Now this isn't a spread chart like that one. This just shows each year what was the highest spread reading of silver versus gold during that year. Okay. And we got 50 years of history here. Okay. These are percent on the left. The red arrow shows 2%, meaning at some point during 20 of the past 50 years, silver has at least traded up to 2% of the price of gold. Didn't require a big bull market to do that. Yeah, a couple of the bull markets that got it up there, but many other years were up there anyway. 20 years out of 50, so it's quite common. Right now we're at 1.15%. And if you, I don't show 2025 there, it's a little bit lower than that right now. But if you go up just to 2% again, which is not astounding on this chart, we've been suppressed for quite a few years here, you can see. If you say, oh, I'm going to go up to the old level, 2% of the price of gold. Okay, well, what does that mean? Well, let's say gold only does another eightfold. This is, again, I'm arguing this is a different time than those, but let's just assume it does what it did in 1980. It does what it did in 2011 in terms of dimension of gain. And you see $8,000 gold, will silver be what? $160.
Yeah.
Okay. Well, where's silver now? What percent gain is that? It's amazing. And what if gold went beyond that? And what if silver went higher than 2%? It's been higher than 3% frequently. 2.5% is no big deal. So, but the point is, silver's cheap in relation to gold. And when we measure it closer up, this spread, we can see reasons to start buying silver versus gold if you get it above 1.16%. Again, right now we're 1.15%. So not much.
So we're right there.
Yeah, we're not far away from breaking this spread out and probably causing a move in the performance up to that red line. Wow. May not look like much on this chart, but it's enormous in terms of the portfolio gain from silver versus gold. And that's what happened, by the way, in those bull trends that peaked in 1980 and peaked in 2011. Silver gushed in the last year, left gold behind.
Yeah. Okay. So this is essentially taking the gold to silver ratio and turning it into a percentage.
Percentage scale. Yeah. Simply dividing the price of silver into gold, expressing it as a percent.
Yeah.
Yeah.
Okay.
It's the same thing, but just measured a different way. Yeah.
Okay. So the levels on silver where I've got the yellow and green lines, you don't see that as very likely of it coming down to
no, not now. We had our chance. We had our chance. And and when the election occurred, everybody sold gold. What did they do? They bought stocks. Okay, boy. Okay, well, right now, if you bought stocks on that day, November the 6th, you're making a couple percent. Whoopee. Okay. November, December, January, February, 4 months, you make a couple percent. Gold collapsed to a 25.40 low right after that event.
Yeah.
Let's tell gold, we don't need no more inflation. Trump's going to cure inflation. Yeah, bet on that. Commodities are about to explode, by the way. And it's now 28.50 or 28.70, I think, as we're speaking. Okay, so it left behind anybody who shorted gold based on the news, the event again. I hate events. Is getting killed in gold. Yeah, they're making a couple percent in the stock market, and I bet that doesn't hold up. But they're getting killed. So gold said, "Hey, that's not important to me, and wait till the stock market drops, enough to scare the public, and then they'll suddenly realize, oh gosh, I thought, I knew reality." Okay.
Okay. That is encouraging, sir. Okay, let's see. We hit Jake's question on industrial demand. Platinum and palladium, macro view on platinum and palladium. I feel like they're really cheap right now in relation to gold and silver. What are your thoughts on that?
Yeah, when we talk about platinum or palladium, and we cover them once a month in our general commodity report, we cover all the commodities. And we assert now that commodity complex, which had a major move from late 2020 to 2022, doubled in price. Still cheap, even at the peak, by the way, historically. Got up to 140 on Bloomberg. Its high in 2008 was 237, okay? Still cheap. Came back down in the 100 area, corrected, and oscillated either side of 100 for the last 2 years. Right now it's 102, 103. Last month's close broke it out on our quarterly momentum, saying to us, the Bloomberg Commodity Index is no longer asleep. It's waking up and it's going back up. We can see the evidence when we look at components like energy, platinum, palladium, grains, and so forth. Yeah, there's the Bloomberg. You can see it had about a 50% pullback to its low.
Yeah.
And boy, those lows in 2020. And by the way, during that period from late 2015 to 20, gold doubled in price and commodities went down. Okay. Commodities exploded without the help of gold in 2020. Gold had already seen 2000 plus, and then commodities exploded while gold was in a range. So again, no correlation between commodity prices and gold. Commodities then corrected big time, 50%, now have proven a base. Momentum says you've already broken out of that base. Price is yet to. You get up to 105 again, and we've been there before. We've got some price reasons to assume you're going to blow that base totally out and you're headed into a whole nother up leg. At that point, commodities will also be a place to be as an alternative to the stock market. And at that point, commodities will then rejoin a positive relation with gold. One of the times in history that occurred and you need to pay attention to was 79 and late 70s. We had a global recession. They call it stagflation, and yet commodities exploded, not as much as gold, and gold exploded. And stock market was a wasteland. And I think we're in the same position again where that's another place to be, is the commodities and commodity-related stocks, like agricultural stocks, energy-related, and so forth. Platinum and palladium. Palladium had a blow-off type move a couple years ago and collapsed back down to reality. Okay. It was unique to it. It wasn't a common thing for the commodity complex. And it's now back in line with the commodity complex, and it looks like it's basing and trying to turn up. So we give it a thumbs up. It's cleaned up its act after that orgy on the upside. Platinum has behaved very much like, platinum, like the Bloomberg. Now, yeah, back in 2008 and 9, when gold was going up, platinum peaked and collapsed well before gold ever even peaked. Gold peaked in 2011, that second high in platinum.
Oh, right.
That one over there. That happened to be coincident with highs in the Bloomberg Commodity Index. In 2008 and again in 2011, a secondary high in the Bloomberg. Platinum did the exact same thing. It didn't reflect gold, it reflected the commodity complex. And look at what's happened since the 2020 low. Platinum exploded, not to high levels, but came up out of the hole. Yeah, big move.
Yeah, that's a big move.
Yeah, and then came back down and built a sideways range for the last couple of years, just like the Bloomberg Commodity Index. And I think that the price chart lines you've got there are probably pretty valid. Momentum is saying, yep, I'm going to turn up. So it's treated as part of the commodity complex. Do not treat it as a monetary metal. It's a precious metal. Gold is not a precious metal. It is a monetary metal. So is silver. So we use those labels on the markets. We separate them. We don't consider gold and silver to be precious. They're monetary. They behave differently. But I think right now you're about to see a situation where platinum will is with commodities, and commodities will rejoin gold. And so at that point, a lot of investors will think, oh, platinum's back with gold again. No, it's with the commodity complex.
Okay. All right. Okay. Encouraging. Yeah, it's got into platinum probably way too early, but just kept buying it on pullbacks, Okay. Macro view on copper. What do you see with copper?
Same thing. Copper tried to get crazy several months back, shot up over $5, which is all-time high. And it collapsed it back down to 4 because the Bloomberg just wasn't ready to go. Okay. And copper thought, I'm going to go. Well, copper moves very much with the Bloomberg. Okay. Don't treat it as separate. And it pulled back sharply to rejoin the Bloomberg and then went into a basing pattern under $4, and now it's 430 or so. It too looks like it's ready to rejoin on the upside with the overall commodity complex. So I think copper looks good too. But treat it as part of, you can see it shot to a new high there.
Yeah, right here.
Yeah. See, silver didn't do it, gold did, but copper did. Well, then it collapsed back down. That was in 2024. And you based just like the pullback we've seen in the Bloomberg, sharp high, sharp pullback, range bound, but above the lows that we saw back in 2020, which were way down there, then $2.20. So copper looks good. We think it's basing, and if the Bloomberg turns up, which it looks like it's doing, I think copper will follow.
Okay. All right. That's encouraging. 'Cause usually during recessions, we get
Yeah,
pullbacks
right.
and
Yeah,
what?
yeah. Forget it.
Okay.
I know that notion of what Dr. Copper, economic metric. No, And many times during recession, copper does quite well.
Okay. All
Okay.
right.
Okay.
Good to know. Okay. Yeah, I've been accumulating copper on pullbacks, so that is nice. Macro view on uranium.
We got bullish on uranium based on annual momentum. In 2018, it was coming up above $20. Okay, it had been 75, it had collapsed down under 20, and we saw enough momentum breakout at that point. Annual momentum, where we measure uranium monthly prices versus a 3-year average. Okay, it had based and broken out. Price followed in suit, and then over the last several years, we've gone up there well over 100. Okay, in August of last year, it came back down through the mid 80s. And we said, uh-oh, we've broken enough stuff to generate what we'd call a serious correction. And we thought that the correction would drive us down toward the 36-month average or the 3-year average, correct back to those long-term annual means, because frankly, it wasn't just the averages we thought it would pull back to, which are rising averages, obviously, because the market went up. But it was the momentum said, no, you probably got to go back down there. And we did. We did this year with the recent drop. We got back down to and slightly below the 3-year. We got back down to the 36-month average, which not always the same. And I think you got to watch uranium now as a basing situation. And the uranium stocks, there's one called the URA, but there's Sprott also has one that behaves a bit differently, a little more orderly actually on his. It's got a Sprott mining, uranium mining ETF. But especially URA tried to go up and make a new high recently while uranium was still correcting, and it got smacked back down. Not now, kid. We're not ready. Okay. And sure enough, uranium came down, so it pulled back. But I would watch that sector for basing action. And we will alert our subscribers when we see sufficient action that says, okay, the pullback is over. Yeah, it went to where we wanted it to go, but we want to see signs of an upturn now. And it'll probably take a couple months. And when we see that, we'll say, okay, green light again. But right now, I think probably the worst we've seen in uranium is over in terms of that pullback.
Okay. That's encouraging. Macro view on oil. What do you see with oil?
Very much in line with the Bloomberg. It collapsed from its 2022 high, $130, just short of an old high at 140. Collapsed back down into the high 60s. And since the Bloomberg has gone sideways for a couple of years, so has WTI crude. It's been a boring situation. You got a chart coming up there?
I got it right
Okay.
there.
Yeah. Okay, you got that 130 peak, and then they collapsed back down, just like the Bloomberg did, about halfway back to its prior low. And
Hmm.
then you went into boredom.
Yeah.
Okay. You had nice up moves. You had one move in the mid 90s, and you got up in the 70s and 80s. But basically, you could draw a horizontal line about through $70 or so,
Okay.
kissing your sister. It's just gone sideways. We get up to about $75 on a monthly close. Right now, we're not there. We missed it last month. And that trend line you've got on price will be validated by a much longer trend line that we have on quarterly momentum that says, yeah, you're awake, you're going back up. Okay, so I think that the crude oil market is behaving very much in line with what we're seeing in general commodities. It's not special. The only difference I would say this time is probably in the next up leg in commodities, unlike that first one you see from 2020 to 2022 in oil, which was huge percent.
Yeah.
Oil will not be the leader. It's going to go up with commodities and have a nice move, but I suspect grains will beat it
Hmm.
on a percentage gain basis this time as a subcomponent of commodities. Well, oil will participate. You probably go up, take out those highs up there, 130, 140. But I think on a percent basis, probably we'll see more gains out of the grains, out of the food components.
Okay. All righty, let's go ahead and round out. We got one last listener question from Jake. He says, have you made any adjustments in the past week based on DeepSeek and potentially declining hypothetical demand for large language model related chips like NVIDIA's GPUs?
No, we've issued reports. They're technically based, so we don't care what the cause is. And we viewed NVIDIA as vulnerable anyway, well before this happened. Quarterly momentum of NVIDIA is broken. Price even looks a bit broken. And therefore, we are skeptical of any further upside. The fact that we have something to talk about that might have caused that, fine and dandy. But remember the dot-com top, it wasn't really an issue of something happening. It was an issue too long, too overpriced. Yeah, the reality you're talking about is great. It's going to happen. It's going to be better than you think, but still we're overpriced. So the NASDAQ went down 82%. And it wasn't because of some alternative, or speedier way to do it and less costly. So, I can't get into that. That's a nice story to go with it. But we already thought it was topping, and our quarterly momentum study of NVIDIA, regardless of what it does, okay, says you're broken, okay? I don't know where it'll go, but remember it was one of the leader symbols in the top 7. It's important. Microsoft's also taken a big dump lately, offset some by Apple, but these things are happening, and people are ignoring them. Don't ignore them.
Okay, all righty. Any final thoughts, Michael? Anything I should have asked that I didn't?
No, just to wrap up again, I think 2025 will be a big year in terms of dynamics of markets. Some will be down, some will be up. And I think the best place to be, we're waiting for key triggers. We depend on numbers. So you break that NASDAQ 100 and we specify the numbers in our reports, and it's not far below the recent toe marks of the NASDAQ. You're on your way down. That's the leader index. And I think at that point, you'll see a spark of interest in the alternatives. And I think the year then could get very dynamic in terms of the money flows out of something into something. And again, our favorite right now, and again, we've got some numbers we'd like to see triggered, but are the miners, gold and silver miners.
Okay. If viewers want to get a hold of you and follow your work, how can they do so?
OliverMSA.com. You can go there and look at a lot of our past reports, better understand our unorthodox way of seeing reality, and request some samples.
Okay. I got to say, I get your newsletter, and it gives me so much more conviction when I'm, when I'm looking at something. I'll be like, okay, $33 looks pretty good to me. And then you come out with your report and the number is $33.14. And I'm like, okay, he's got it. I like it a lot. It's a great report, and I highly recommend it.
Thank you.
Thank you.
Thanks, Steve.
And thanks for coming back on the show, Michael. But I look forward to our next talk.
Good.
And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.